A line has formed outside the newest sneaker store, and thousands of people are walking beneath a roof that you own. This looks like the easiest business in the world. You provide the building, retailers fill it with products, customers spend the money, and at the beginning of every month, rent arrives from 100 different stores. But a busy mall can still be a bad investment. A nearly full mall can still run out of cash. And the largest store in the entire building may pay you almost no rent at all. Because when you buy a shopping mall, you are not really buying shops. You are buying a machine that converts human attention into real estate income. If people stop moving through that machine, or if the debt behind it becomes too expensive, the building can lose tens of millions of dollars in value without losing a single brick. So let us buy one. Imagine a fictional property called Rivergate Mall. 800,000 square feet, 2 department stores, a cinema, a food court, and about 120 smaller tenants. The seller wants $240 million. That price is not based mainly on the concrete, the glass, or what construction originally cost. Commercial properties are usually valued by the cash they can produce. The key number is net operating income, or NOI, all property revenue minus the cost of operating the property, before interest and income tax. Suppose Rivergate produces $19.2 million of annual NOI. Divide that by the $240 million price, and you get an 8% capitalization rate, or cap rate. In simple terms, you are paying $240 million for a property that currently generates $19.2 million before debt. You're not buying the past, you are pricing the future. And that is the first dangerous detail. A mall's value is an opinion about income that has not arrived yet. If investors later believe that income is less secure, they demand a higher cap rate and the building becomes less valuable, even if it looks exactly the same from the highway. You probably do not pay $240 million in cash. Imagine a lender finances 60% of the purchase, or $144 million, while you and your investors provide the remaining $96 million. At a hypothetical interest rate of 6.5%, interest alone begins around $9.4 million a year before principal payments, lender reserves, or loan fees. Your $19.2 million. NOI now looks very different. After interest, roughly $9.8 million remains before taxes and major capital spending. That can still be an attractive return on $96 million of equity. But it also reveals what you really own. You own a thin layer of cash between the mall's income and its obligations. The cleaners are paid first. Security is paid first. The electric company, insurer, local government, and lender are all paid first. The owner receives whatever survives. This is why debt makes a good mall more profitable and a weak mall more fragile. The mortgage does not care whether shoppers felt optimistic this month. Now we need tenants. But mall space is not one uniform product. The small stores along the corridors, called inline tenants, usually generate much of the rent. They pay for access to customers already moving past their doors. The large anchor at the end of the corridor plays a different role. It may occupy more than 100,000 square feet, yet pay a very low rent. Sometimes the anchor owns its own building and the land beneath it. In that case, the mall can appear to contain the store without technically owning that part of the mall. This is not theoretical. Loan documents for San Diego's Fashion Valley showed a Nordstrom occupying more than 220,000 square feet, around 16% of the property's net rentable area, with zero underwritten base rent. The store was still responsible for common area charges, and it reported roughly $147 million in annual sales. Why give the largest player the cheapest deal? Because the anchor is not only a tenant, it is customer acquisition infrastructure. Rivergate may earn almost nothing directly from its department store, but the cosmetics shop, jeweler, and cafe on the route toward it will pay premium rent for the traffic it creates. The anchor supplies gravity. The smaller stores monetize the orbit. Base rent is the predictable foundation. A tenant agrees to pay a fixed amount, often quoted per square foot per year, with scheduled increases over the lease. At the high end of the industry, the numbers can be substantial. Simon Property Group reported base minimum rent of nearly $62 per square foot across its U.S. malls, and premium outlets in early 2026, with occupancy of 96%. But Rivergate is not automatically worth $62 per square foot. Rent depends on location, tenant demand, store position, lease length, and, most importantly, how much retailers believe they can sell there. A store does not care that your marble floor was expensive. It cares whether enough profitable customers will cross its threshold. This is why two visually similar malls can have completely different economics. One has a waiting list of brands and can raise rents. The other offers discounts and free months just to hide empty storefronts. Base rent is only the first invoice. Many tenants also reimburse part of the mall's property taxes, insurance, maintenance, cleaning, security, landscaping, and common area utilities. These payments are often grouped under Common Area Maintenance, or CAM, and other recoveries. This does not make operations free for the owner. Some costs cannot be recovered. Leases can cap annual increases. Anchor agreements may allocate costs differently, and the owner normally pays the bill before collecting each tenant's share. Then there is percentage rent. Above an agreed sales threshold, some tenants pay the landlord a percentage of additional sales. In a great holiday season, the owner participates in the upside. In a weak season, only the base rent may remain. Finally, the mall sells its most concentrated pockets of attention. Kiosks rent tiny spaces in the busiest pathways. Brands buy digital screen advertising. Telecom companies may pay for rooftop equipment. The owner can license space for product launches, holiday displays, vending machines, and pop-up stores. Urban properties may also collect parking revenue. Individually, these items look small next to a department store. Together, they reveal what the mall is actually selling: access to a moving audience. Now comes a cost that ruins the fantasy of passive rent. When a desirable brand agrees to open at Rivergate, it may not simply take the keys and start paying. The space might need new plumbing, ventilation, flooring, electrical capacity, signage, or an entirely new storefront. The landlord may provide a tenant improvement allowance to help pay for that work. It may also pay a leasing commission to the broker and offer several months of free rent while the store is built. So signing a 10-year lease can begin with the mall owner writing checks, not receiving them. Suppose a 10,000 square foot restaurant receives a fictional $80 per square foot improvement allowance. That is $800,000 before the first meal is served. Add brokerage fees, permitting work, and rent concessions, and filling an empty unit becomes a capital project. The lease may look profitable over 10 years. The cash leaves today. This creates a timing problem. A mall can announce impressive new tenants while its bank account moves in the opposite direction. Growth consumes cash before it produces income. And if the tenant fails after 2 years, the expensive kitchen it leaves behind may be useless to the next business. Rivergate opens every morning, whether it is full or half empty. Security guards patrol the entrances. Cleaning crews maintain acres of floors and restrooms. Escalators, elevators, fire systems, doors, roofs, loading docks, cameras, and parking structures all require inspection and repair. Heating and cooling must keep enormous shared spaces comfortable. Insurance and property taxes arrive regardless of foot traffic. Some of these expenses vary, but many do not fall quickly when one tenant leaves. And then there is capital expenditure, which NOI does not fully capture. Replacing a roof or an HVAC plant is not an ordinary daily operating bill, but the cash is still real. A mall owner who ignores these future costs can report healthy NOI, while the building quietly accumulates a renovation bill. This is one reason a cheap mall can be extremely expensive. The purchase price may be low because the next owner is really purchasing years of deferred repairs, outdated interiors, and empty units that require millions of dollars to make leasable. The discount is not always a bargain. Sometimes it is an invoice. Most people judge a mall by one number. How full is it? Owners need at least 4. First is leased occupancy. How much space is contractually committed? Second is rent-paying occupancy. How many tenants have actually opened and started paying? Third is sales per square foot. Are those stores generating enough revenue to survive? Fourth is occupancy cost. What percentage of a retailer's sales disappears into rent, maintenance charges, taxes, and other property costs? These numbers explain why 95% occupancy can mean strength or desperation. A healthy mall is full because tenants compete to enter. A weak mall can look full because the owner has accepted temporary stores, discounted leases, or long free rent periods. Strong properties can be extraordinary. Fashion Valley's Loan Materials reported more than $1 billion in trailing annual property sales in 2023, with inline sales above $1,400 per square foot, excluding Apple and Tesla. At that level, a retailer can justify expensive space because the location produces expensive results. The question is not simply, do you have tenants? It is, can your tenants afford to stay when their leases reset? There is another complication. You may own Rivergate without having complete control over it. Large anchors that own their parcels often sign reciprocal easement agreements with the mall. These contracts coordinate parking, access, operating standards, construction, and future expansion. They can also give an anchor approval rights over major changes. Imagine the old department store closes and you want to replace it with apartments, a grocery store, or an entertainment complex. The redesign may alter parking ratios, traffic routes, or permitted uses. Before construction begins, you may need approval from lenders, local government, and other property owners whose agreements were signed decades earlier. So the empty box is not just a construction problem, it can be a legal geometry problem. You are trying to redesign one organism while several parties own different bones. Now we can see the most important equation in the entire business. Rivergate originally produced $19.2 million of NOI and was valued at an 8% cap rate, $240 million. Then several leases expire, renewal rents fall, insurance rises, and NOI drops to $16 million. At the same 8% cap rate, the mall is now worth $200 million. A decline of only $3.2 million in annual NOI has erased $40 million of property value. But assume investors also become more worried about this location and demand a 10% cap rate. Now $16 million of NOI supports a value of only $160 million. The building has lost one-third of its value. The $144 million loan has not lost one-third of its balance. Your original $96 million equity cushion has been reduced to roughly $16 million before selling costs, even though the mall is still open and may still look busy. This is the leverage trap. Income moves a little, property value moves a lot, and debt barely moves at all. It becomes even more dangerous when the loan matures. If a lender will refinance only a percentage of the mall's new, lower value, the owner may need to contribute tens of millions of fresh cash just to replace the old loan. A profitable property can therefore face a cash crisis on refinancing day. So how does Rivergate survive a world where almost any product can be delivered to the customer's door? It stops depending entirely on products. The modern tenant mix can include restaurants, fitness, healthcare, beauty, entertainment, and services, businesses in which the customer still needs to appear physically. Apartments, offices, hotels, and grocery stores can add repeat traffic that does not depend on someone deciding to spend Saturday shopping for clothes. The strongest malls increasingly behave less like retail containers and more like privately operated town centers. Mall of America makes the strategy obvious. The property says it receives around 32 million visitors a year and hosts more than 300 events. Its attraction is not one shop. It is the accumulation of reasons to make the trip. But add experiences is not a magic solution. Cinemas, theme parks, restaurants, and water attractions require specialized construction and can be expensive to replace. The owner is exchanging some online shopping risk for operating and capital risk. The objective is not entertainment for its own sake. The objective is durable visits. Owning Rivergate is not mainly about collecting rent. It is about managing a chain reaction. The right tenants create reasons to visit, visits create foot traffic creates store sales allow tenants to pay higher rent and renew their leases. Rent creates NOI, and NOI, combined with the cap rate, creates the value of the entire property. Break the chain anywhere and the damage travels backward. This is why the best mall owner is part real estate investor, part lender, part urban planner, and part talent scout. They must know which tenant attracts the customer, which tenant monetizes the visit, which empty space deserves investment, and which expensive redevelopment will never earn its cost back. So, is owning a shopping mall a good business? It can be an exceptional one. A well-located property with productive tenants, manageable debt, and repeated reasons to visit can generate stable cash flow and enormous long-term value. The strongest operators are not surviving because malls were secretly immune to the internet. They are surviving because scarce, productive locations still give retailers access to customers they cannot easily find elsewhere. But this is not passive income in the ordinary sense. You must fund improvements before rent begins, operate a small indoor city every day, protect the sales of businesses you do not control, negotiate contracts that may outlive entire retail trends, and refinance a loan whose balance can be far more stable than the value of the property beneath it. From the parking lot, a mall looks like a collection of stores. From the owner's office, it looks like a leveraged network of promises. Promises from tenants to pay, from customers to return, from lenders to refinance, and from the neighborhood to remain valuable. The stores are not the real asset. The real asset is the habit of thousands of people deciding that this place is still worth leaving home for.